Hey friends, today we're diving into a hot topic that's been buzzing in the Singapore investment scene, the wave of companies delisting from the Singapore Exchange, SGX. Now, most people think this is a sign that our local stock market is in trouble. But I've got a fresh perspective that might change your mind about these delistings. I've been analyzing market trends for years, and I'm here to show you why this shift might actually be a natural part of our evolving financial landscape. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers with over 768,000 reads and 53,000 likes. I've produced over 700 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Let's start by addressing the elephant in the room. Why are companies leaving the SGX? Over the past decade, we've seen a number of firms opt to delist, mainly through takeover come privatization offers. This trend has got a lot of people worried, and critics are quick to point fingers at the SGX. But here's the thing. This isn't just a Singapore problem. Take Hong Kong, for example. In the first 8 months of 2024, they welcomed 43 new listings, but also saw 31 companies wave goodbye. And it's not just Asia. The London Stock Exchange had a rough 2024 with 88 delistings compared to only 18 new entrants. So we're not alone in this boat. It's a global phenomenon that's affecting markets worldwide. Now, you might be wondering, Iggy, why are these companies leaving? Well, it's not as simple as you might think. There are several key reasons driving this trend. First, many companies cite high compliance costs as a major factor. Second, thin trading of shares makes it hard to justify staying public. Third, persistent price undervaluation frustrates management and major shareholders. And fourth, many companies want greater management flexibility without the scrutiny that comes with being public. Think of it like this. Imagine you're running a lemonade stand, but you have to spend half your time filling out paperwork instead of making lemonade. That's kind of what it feels like for some of these companies. The administrative burden can outweigh the benefits of being listed, especially for smaller firms. Here's where things get interesting. Back in the 90s, getting listed was like getting into an exclusive club. Companies were willing to pay big bucks. We're talking about $20 million for a main board listing. But times have changed, my friends. The prestige of being public isn't what it used to be, and the practical benefits have shifted dramatically. Today, it's the opposite. Companies are paying a premium to leave the market. It's like they're saying, thanks for the party, here's some extra cash for the trouble. Of course, whether this exit premium is fair is often a hot topic of debate. The Securities Investors Association Singapore, or CAS, has been actively fighting for better exit offers, especially when the original offer seems too low. They're the watchdogs making sure minority shareholders don't get shortchanged in the process. Here's the kicker. Companies don't need to be public to get funding anymore. There's a whole buffet of options out there now. Private equity firms are flush with cash and looking for good businesses to invest in. Crowdfunding platforms have democratized capital raising. Venture capital is more accessible than ever before. It's like having multiple ATMs to choose from instead of just one bank. This fundamental shift has changed the calculus for many businesses when deciding whether to stay public. Now here's where I want you to put on your thinking caps. What if we started looking at delistings not as a problem, but as a natural part of market evolution? What if this is just the market efficiently sorting itself out? Companies that truly benefit from being public stay listed, while those that don't are finding their way to more suitable ownership structures. For shareholders stuck with inactive, undervalued stocks, a delisting might actually be a blessing in disguise. It's like finally being able to sell that old car that's been sitting in your garage for years. You get to cash out and invest in something with more potential. Rather than watching your investment languish for years with thin trading and poor prices, you receive a cash offer that lets you move on to better opportunities. Sometimes a clean break is the best outcome for everyone involved. Even for the SGX, quality might be better than quantity in the long run. Wouldn't you rather have a handful of strong, actively traded companies than a bunch of inactive ones? It's like having a few close friends instead of a bunch of acquaintances you never talk to. Sure, the exchange loses some listing fee revenue when companies delist, but a vibrant market with active trading and quality companies is ultimately more sustainable and attractive to both local and international investors. Now, don't get me wrong, I'm not saying the SGX should ignore these delistings. They're working hard to boost liquidity and generate interest in smaller companies. The Monetary Authority of Singapore is also stepping up with new measures to revitalize the market. These efforts are important and necessary to ensure Singapore remains competitive as a financial hub. But we also need to be realistic about the changing nature of public markets globally. But here's the real talk. We need to adapt our thinking. Listings and delistings don't mean the same thing they did 20 years ago. It's like how we used to value phone books, but now we just Google everything. The world changes, markets evolve, and our perspectives need to keep pace. Companies that choose to list today need to do so with their eyes wide open, fully aware of both the benefits and challenges that come with public status. So here's the bottom line, friends. Delistings from the SGX aren't necessarily a sign of doom and gloom. They're part of a global trend that reflects how markets are changing. Companies that choose to list today need to be prepared for the challenges. And as investors, we need to do our homework and find those hidden gems. The market is still full of opportunities if you know where to look and how to evaluate them properly. Remember, this is a buyer beware market. It's like shopping at a flea market. There are treasures to be found, but you got to know what you're looking for. You need to perform your due diligence, understand the business models, and make informed decisions. Not every listed company is going to be a winner, and that's okay. That's how markets work. Before we wrap up, I want to hear from you. What do you think about these delistings? Are they a cause for concern or just part of the natural market cycle? Have you been affected by a company delisting? How did you handle it? Your experiences and insights are valuable, so drop your thoughts in the comments below. Thanks for watching, and I'll see you in the next one. Remember, in the investing world, change is the only constant. Stay adaptable, stay informed, and most importantly, stay invested in your financial education. This is Iggy from the Investing Iguana, signing off.